Stenemo, welcome back to the show.
Thank you.
How are you doing today?
Wonderful.
Amazing. So now we're going to continue this prolonged discussion about financial independence that seems to go deeper and deeper the more you get into the water. We're already on mini episode 4. Can you believe it? So maybe if you could just briefly summarize what we talked about last time, especially when it came to 4 buckets analogy, what you did after the fire has been reached.
To summarize the 4 buckets, it's very important you don't have all your money in one basket that is hard to reach. You want to have money that's somewhat easily accessible, but you also don't want all your money outside of investment because then you don't have actual compound interest. So that's basically how the 4 bucket tries to do a trade-off between 2 extremes, which I think is for most people it is adjust the 4 buckets so that it fits their situation. So for some people the 4th bucket or 1st bucket will be very big, small, depending on living.
Yeah, so it's good to have a framework at least. And I remember that you explained quite eloquently and beautifully on the process of getting back water from 3rd bucket, since this one was more like generating and the 2nd bucket played an important role. Maybe we could start a conversation there if you want.
Sure.
So what role would you say the 2nd bucket has before the line has been crossed and after, just to give a sense of how it might shift depending on how your economic situation looks like with the savings?
So in essence, you could say that your wallet, part of your 1st bucket, this is not money that you want to make money on. And you could say that the money that you have on your bank account that has some interest, that's part of your 2nd bucket, where at least not really losing value, as long as you have a decent interest rate. It's hard these days. But in essence, your 2nd bucket should be making money, not lose, or at least not losing money too quickly. While your 3rd bucket, that's really the only bucket making. So investment into your apartment, investing into stock order investment really be the bucket that makes those be the separation.
Yeah, exactly. And maybe we should just for clarify once again, like, okay, when we talk about the 1st bucket, we mean this. In other words, do a more thorough investigation of what the definitions are and how they can look like and how they might shape. So why don't we start with telling a little bit more about the 1st bucket to give some kind of rundown on how it looks like?
So for most people, the 1st bucket is money that you know you might, but you don't know when you will need it. So when you buy groceries, you know you have to have some money on your bank account that's easily accessed. But for some people, this could be a very big bucket. But in essence, just money that is expected to be needed and money that is so small amount that having it invested where it's not easily accessible is not worth the effort because it's not a big part of your portfolio.
So you can call it maybe the cash and the wallet or emergency fund. All of these are classified as the 1st bucket.
Yeah, those would all.
Because one has like a credit card or debit card. And is this like the bucket 0 or is it still tied to the more accessible 1st bucket? Just clarify for myself.
Yeah, I would say that knowing that you have possibility of loan money from credit card, for example, means that you don't have to have as big a bucket because you know you have a way to borrow money from your credit card. So that's not really part of the bucket. So much as a way of having a buffer that does cost you having money on the stock market, for example. So say that you know that 1 in 100 that your car breaks down tomorrow. That's not reason enough to have enough money in your wallet to buy a new car. That means that you have a way of surviving without the car until you have a new car. That's essentially the key of the buffer.
Okay, so now we covered the 1st bucket, which is like, okay, the most accessible one could be money that would be immediately spent towards a certain outcome, whether regular or irregular. But the 2nd bucket still, at least for me, needs some further clarification because maybe it differs between different countries. But is it some kind of an emergency savings fund that still can function as some kind of a smaller vehicle, or does it have other properties that makes it more, inaccessible? Could you tell us a little bit more on like how the 2nd bucket looks like if you go into the bank on your iPhone or Android?
I think you could basically say that the 2nd bucket, you don't want it to be completely inaccessible. You might need it within 1 year. So say, for example, that you want to buy a bigger apartment, your 1st apartment. That means that you don't want the money to fluctuate a lot, as it would if it was on the stock market. But you also don't want to keep it in your wallet, where you know that you lose value on due to inflation. So that's really where the 2nd bucket comes. It's the place where money doesn't lose value. It doesn't necessarily increase in value like it does a stock, but at least you didn't lose value.
So it is like protected from inflation, but in in general, but on the other hand, you can't really access it in the same way. Maybe it's a little bit of a delay, maybe a day or two.
Correct.
Okay, so could you say that it's mostly like normal savings funds that could be classified to the second bucket, or are they more like explicit, like for instance in the US, like 401k or Roth IRA, etc.? Are they more classified as second bucket, or could I start a second bucket like on the drop of a hat by calling it savings account and pour into it and make sure to have some kind of protection against both the harm but also have minimum volatility also in the upward direction?
Yeah, I would say that's a good summary, but it really depends on your life situation. So that's why the terms are quite good, because they're quite vague so that they can fit your specific situation. So the middle, the second bucket, it's basically you have to say, how much risk am I willing to take? What's safe enough for me? For some people, that would be a very safe bank account. For other people, they could see their apartment or their similar investment be safe enough to be considered in the second bucket. And if you know that you're going to live in the same place for many years, then you could see your apartment as really a safe investment. And you don't necessarily see it's a big part of your investments. It's more a way of thinking of the second bucket as saving up for a big investment where you don't want it going up and down.
Okay, so that's interesting, because it seems like the buckets are more principles rather than referring to, like, for instance, this is a savings account, this is more expense account, stuff like that. So you mentioned like apartment. Let's say if I own like real cash, some kind of a drawer, if that, I can call that one first bucket. The apartment is a second bucket. That these bucket terms can still apply as long as they are corresponding to the amount of risk and potential rewards that are present in these circumstances.
Yes.
Okay, cool, because that maybe wasn't clear to everyone, at least not for me. So I think we can move on now to the third bucket, which, if I understand correctly, is more of a pool rather than a bucket, especially when achieving a certain kind of financial leverage. So is it more than just the stock market?
Yes, as it really depends on for each person what they want to have, but it's supposed to be considered more high risk, where the expect return higher than in the second bucket. But that's really up to each person how they want to sign.
So I guess that there is some risk threshold that is passed from calling second bucket to the third bucket. What would you call the exact threshold, for instance?
So it's not so much risk, the expected reward. For example, for some people, gold considered a very safe. It's almost as it could be considered cash for some people, where you want to have some gold in your mattress just in case you need it. So that would be considered for them basically a buffer for an emergency. While for other people, gold considered the fourth bucket, extremely high, depending on how. So the same investment can fit in many buckets depending on the person and depending on how it. So for example, in the US, there was a big increase in the value of house because people respect that they would continue to grow up. So even though it for most people could be seen as the second bucket, to own your own place where you yourself know that you can live here forever because you have very small cost. If you instead buy 5 apartments and you rent out, then this comes a fourth bucket level of high risk, but you also expect high reward. But the trade-off here is, of course, that the fourth bucket you should be okay with losing. It's really here in the third bucket. It should be things that over the time horizon where you have it invested, let's say 10, because less than that is too much fluctuation. So over this 10 years, if you buy gold just to hold, that wouldn't really be a good investment. Then it would be better to own, let's say, a company that buys and rents out apartments, so that you don't have to take such a big risk of owning a specific apartment in one town, but rather own a small piece of an organization that thousands of apartments across the country. So that's really the same expected reward, but less risk.
Okay, I like the statement that provides like same asset could be used in different ways that might adjust them bucket wise. So for instance, you mentioned real estate could be fourth bucket, real estate second bucket, stuff like that. Have you seen like real examples of people treating like safe investments as basically very speculative, that they had this kind of reframing on how they wanted to use it?
A really classic example of this specific thing is the East India companies. So that basically the very first stock company. So what used to happen was that a rich person bought one ship, handmade, and then they sent off this ship with a captain and crew that they had gathered for this specific voyage. And the likelihood of the people coming back was quite low because it was so dangerous. So there's a lot of cost just in order to send away the ship with a lot of goods that then were supposed to be traded for spice. And the likelihood of the money to come back was about 50-50. So you had to be wealthy enough to be okay with sending off a ship and possibly losing everything. And that's very similar to you buying a big apartment and borrowing a lot of money on the bank, that you do not know for sure that it's pay off, but you know that the expected reward is quite high. So what happened during this period was that multiple people who did not afford to buy their own came together, and together they were able to buy 100 ships because they were able to build a better factory and get better crew because they had a better process of selecting people. They were also able then to have different ships that were good to complement each other. So a lot of positive externalities happened by just scaling up, which no one person could have to do. But it also meant that even if half of the ship were to sink on the way back, it wouldn't make that much of a difference because each ship made 10 times the profit. So every person who owned stock in this company ended up getting much more money back than they put in. And this is essentially how the stock market was created, that by splitting the risk with many people, you will all have same or similar, or even in the case higher expected value because you're able to scale up. But you also decrease the risk. But this will still be a third bucket investment, but it's almost certain profit.
That was a very fascinating story, to be honest. So I guess because it was quite back in the pre-modern times, and it was the antecedent, or whatever you call it, to the modern stock market. I mean, I guess the fact with splitting the risk, reaping the benefits together, made it more it made much more sense for people at that time to be able to spend more on the more risky pursuits and stuff like that. So I guess from there, the concept of, okay, let's together bet on the entire structure of the entire market, stuff like that, it was a natural, it was something that happened naturally after that, or was it more, sporadic? The fact, because it's interesting to see the history of stock market, while we'll still talk about the third bucket. So do you know if that process of investing in ships led to the stock market that we have today?
In essence, it did, yeah. So that was a very early way of essentially buying and selling. Although, of course, the stock market as it is today has developed quite a lot since the last 100 years. Even then, in the 1600s, it really started for.
And it's pretty interesting how much the stock market in itself has evolved from the more, noisy, large halls back in like the roaring 1920s to, I guess you can call it more of a algorithmic way of handling different procedures and transactions and stuff like that. Because yeah, it's interesting to reflect back on the stock market as a whole, though. And do you want to say a few words on like how one should go about stock market? Because yeah, it's a story that could that many books have been tangentially written upon, and also a lot of people have been dedicated their entire lives to study the stock market. Would you say that it's a wise idea to try to get into the details, or is it more of a case that more involvement does not generate much return as one might expect?
I think if I would summarize the whole stock market investment vehicle, I would probably say that people who are selling it are overselling and overhyped, while people who are scaring people away or not confident in the stock market are underappreciating the long-term expected reward. So it's a lot of people either looking too short-term or looking too long. And it's always a case of each individual. There is different answer for how to do it, and it really depends on why you do it and over how long time you do it. So as an investment for 100 years, no person would say that it has bad idea to be invest stock market. There has been no alternative that has been even close to as good return on investment over 100 years. Even if you buy the best paint book, for example, the Mona Lisa, at the time when it wasn't that valuable, and then you held it until today, it would have been better for you to sell it for a low price than buy the stock market, because no painting has appreciated in value at the same rate as the stock has, with a very few exceptions, and those has only been owned less than a 50-year time. So over 100 years, it is world consent stock market the best vehicle for increasing your investment portfolio quick. But that said, most people do not have 100 years, and a lot of people buy whenever it's buying, and they usually buy something that has gone up a lot of value, and then they end up selling it or even wait till that specific investor's bankrupt, and then they feel like in the short term it's dangerous. And even though they are 30 years old and have maybe a few years of investment, they might rather over that 50-year period hold, for example, gold, and not sell it or buy it, just hold it, which in essence is better than a bank account but worse than most other investments.
Because of the short-term volatility, I guess, that makes unreliable in the short term, but clearer, or weighing machine in the long term. So it seems interesting with the fact that it has gone up so much. And would you say that it's because we as humans have become much better at basically living, taking advantage of the innovations, because stock market pretty much reflects the entire market of a country or a nation or the world or stuff like that? So is that just a reflection of, okay, we as human species have become better at basically giving more value for less?
To a large extent, but it's even more rewarding than that. Even if you were to invest in a very poor investment, let's say that your friend wants to sell lemon, and this lemonade stand might not be that important for the global financial system. It can still make a huge profit on a small investment. And as an investor, you could essentially have your money double without there being a big impact on the market. So by lending out money rather than spending your own money, you're able to help company, either a big one or a tiny one, like the Lemonade stand. And that investment that is essential in order for that company to work, that has to be rewarded somehow. And due to many people wanting to start a company and needing a lot of money to this, they are willing to pay a lot of money to the shareholder for risking their money. And many stock companies go bankrupt. And due to this, many investors reasonably expect a high reward, risk rate. But then if you are a careful investor, rather than putting all your money in one company, if you buy 1,000 companies via a stock, then you don't really have the risk of your money going zero, but you have the risk of all companies on the market going down by 20 or even 30 or 50% in a year. But no stock index will go bankrupt because there are so many companies, and can be quite confident that the government will not intend for the entire stock market to bankrupt at the same day, because that would also mean that the entire organization of society break down. So by investing in the stock market index, you both help society at large, but you also then risk your money somewhat in the short term, but you can be quite confident that over a 20 or 30-year period, your money will more than double.
Okay, that's good. And I want to dedicate an entire episode just to talk about stock market, or even 2 episodes on that. But before we move on, because I think we need to cover the 4th bucket as well to have more the deliberate description on each of them sound like. So if I mention like government bond, options, other kinds of what could you say, intangible assets, are they still considered to be in the 3rd bucket or in the more 2nd bucket? Because I've heard that these one are like alternative investments, but maybe not so volatile, or even more volatile depending on where you put them.
I think to each their own in this case. It really depends on, do you want to have a very safe investment, or do you feel like you want a spice in your portfolio where you take a lot of risk? And it really depends on what time period you're thinking of and what kind of dedication you have. If you feel like gold is fun to invest in just because something that you and your friends are, and you want to trade it frequently, then that would fit perfectly into your 4th.
Because there is this classic book by Benjamin Graham called Intelligent Investor. And if you want to be a defensive one, then you want to spend an equal amount on stocks and bonds as well. And I guess in that case, bonds are more, less riskier. So, but they would still be considered in the 3rd bucket, just to kind of clarify it for anyone that have read the book.
Could you clarify?
So at least there are 2 kinds of investors according to Benjamin Graham. The first one is called the defensive one, and the other more I don't know what the other one was called. But anyway, the defensive investor, he because it's more important for like survival and getting the average market return. So therefore, Graham suggested that he would spend as much in stocks as in bonds. So and by hearing that, it's like, okay, if bonds are a safer alternative, are they considered 2nd bucket then? Or are they still classified as 3rd? Just to kind of give a sense of how they are treated in that.
I would say that really depends on your time perspective. So how long are you going to be invest for? What kind of bond are we talking about? And how much money out of your portfolio is it we're talking about? All of these things would influence how you get.
Okay, maybe we could go back to it at some point, because the book quite valuable as well. And it was Enterprising Investors was the other. But anyway, just before we move on to the 4th bucket, and at the time of this recording, Russia and Ukraine has quite a, an argument, and that's a very large understatement nowadays. But the reason why I bring this up is because their stock market is kind of closed at the time. So for all of our Russian listeners, what should they think about right now, seeing as their 3rd bucket kind of non-existent if you want to limit it to just stocks?
So I would say that should be such a long-term investment that you should be okay with the stock market being closed for 1 or 2 years. So you should really think of the 3rd bucket as money that I should need in the next. Ideally, it shouldn't be needed in 5 or 10 years. It should really be money I need much later. And that's why I need some money where I cannot access the stock market. I cannot sell my apartment. I need money now. So if you're able to borrow money on your apartment, for example, that means that your part could in the 2nd bucket, because you have some ability to borrow against. But you do not have that if you're renting an apartment, and if you fully invest in the stock market, and then suddenly you're bright and you need some money and you cannot have that, and you lose your job. That would be a very unnecessary risk to take. So therefore, I would say long term, keep the money in the stock market and really motivate the government to not have the entire society break down just in order to advance short-term gain. So to really motivate everyone to be long-term rather than short-term thinker.
That's a good sentiment for the current times. So as to top it off, and we haven't really covered everything that we still have, so expect the series to go on for much longer. Fascinating way of talking about this personal financing. But the fourth bucket, you mentioned previously that the fourth bucket should be money that you can afford to lose. And yeah, because they are such speculative, you pretty much want to afford to lose them. What are the classic ways of the classic forms rather that the four buckets are, aside from crypto and other kinds of speculative
things that would fit apart from the things we already mentioned? I would say are other resources similar to gold that are fluctuating in such a way that you think that, oh yes, in 10 years time I think this specific thing will be worth. It could be like uranium, for example, is one pop investment, or even silver is also quite popular. And the fact that they are popular does not mean that they are good. It just means that people have started like it, and that's in part because the stock market forms so that people have some money left that they want to take an even higher risk, hoping for a higher reward. But when it comes to these fourth bucket investments, a lot of them have a very similar expected return on investment. So let's say that you buy gold and you think gold is going to double in 10 years. That's actually worth stock market 10 years. So you're buying something that gives you a high risk, but it doesn't actually increase your long-term return. So if you want to invest in gold, you really have to expect it to do even better than the stock market for it to make sense, which is why for most people, gold isn't really something I would recommend unless you really think that stocks are overvalued. And then you think that as long as not gold and down, if you're okay with one of them going, then you could think of it as a broadening your risk decrease. But that also, of course, means that you have to be certain that not both of them go down. And then you could even think of it as buying a big portfolio of many things, like having some small percent in a forest that you own the specific forest. But then I would really say that the same expected reward in buying a company themselves for it, or same thing with rather than buying multiple house, buy a company that, and then you're basically back to the stock. And you could say that this specific stock that is invested in, let's say, uranium mine, this would be a stock that's maybe 1,000 times higher risk than buying the stock market index, but you still think it's an interesting investment because you believe in this specific company. Then you could have this stock in your fourth bucket.
Okay, so it's more of a risk or potential ruin tolerance for the fourth bucket. For instance, like play money, as one might call it, to afford the short-term one.
It's really a case of people needing a reminder that when you buy specific stock that have not formed that well in the last, let's say it's a stock that only existed for 5 years and it has never made profit, you still can believe in it. You can still think that in 10 years time, everyone is going to buy product, but it's still, you should be reminded that this is not a safe investment. And that's why we really have this fourth bucket to remind that this is separate from good long strategy. This is high risk, maybe okay reward, not necessarily as high reward as the third bucket.
Yeah, especially from a long-term perspective. So as to top it off, could you maybe do a little bit of a walkthrough for people who just have a couple of $1,000 in their like main account to see, okay, I already have my first bucket. So in which order should I get my second one, third one, and when should I even start to have the fourth bucket in mind if that ever will be the case? What would you say is the logical order to take first bucket, assuming there was no other bucket for top it off?
So I think we can say that for the person who just finished their studies and started working and possibly doubling the available income, then I would say that you really focus on having a good first and second bucket where you know that if you need a car, then you should be able to at least rent a car if something happens. And for example, the stock market freezes, you should not need to touch your third bucket for the foreseeable future. You should only be putting in third bucket. So make sure the first bucket full before you start pouring in money in the third bucket. And you should really think of this fourth bucket as something that you do to enjoy life, not to have a good return. So if you find that investing is a hobby that you want to develop, then the fourth bucket could be quite early on your list. It could be that you put in 1% of your monthly savings into this fourth bucket to motivate you to put in a lot of money in the third bucket where 99%. And even then, if this fourth bucket does very poorly, you're most likely in the long term to do quite well on the third. So then it doesn't really, the fourth bucket shouldn't make or break your long-term result.
That sounds like a very good statement to kind of end this episode right there, focusing on the four buckets in general, because as you probably heard, there is still a lot to talk about each of them. And the next upcoming episodes will be about definitely about the stock market as a whole, how to maybe go either funds or stocks or whatever is the preferable option. Also about different ways of structuring one's assets, for instance, like drag dragon portfolio or other kinds of stuff. And we also discussed barbell strategy and how it looks like after that. And also maybe we should touch upon crypto as well, because it's such a common topic and many people are interested to know whether one should dip feet or not. And not even mentioned, we still want to mention like the halfway points, going to see how life after fire is. So would you suggest other kinds of bullet points that we should be aware of in the upcoming episode?
Yeah, so many things that I'm looking forward to talk with you about. So I think those are enough for now.
Yeah, that sounds like a great idea. So with that, I want to say thank you very much for everyone who listened. And thank you, Dr. Stenemo, for this conversation.